Thank you for tuning in to Growing Tech Fast, the condensed podcast in which conversations about growing SaaS startups are had with those who have grown them or those who have invested in them. Now, today I'm joined by Akeel Jabber, who is the CEO of Horizon Capital. Akeel, great to have you with us. Thanks for agreeing to be a guest.
No, thanks for having me on, Connor. Appreciate it.
No worries. So, Akeel, for the purposes of our listeners, could you give us a brief intro, firstly to yourself, a bit about your own background, and then secondly, if you want to share with our listeners a bit around what Horizon do, that'd be helpful.
Sure, absolutely. So I'm actually a petroleum engineer turned entrepreneur. So I was actually working in corporate office and went through that, entire journey of trying to quit my job for a while. But I quit my job, over 6 years ago to really, focus on my own ventures. To give you a summary of kind of how I got here and in the investment world, I actually started investing in the stock market. That was kind of my first way of figuring out a way how to make money on the money I've saved. So I did that, I think when I was about 18 years old. And after about, 2 to 3 years of trading, investing in different publicly traded companies, I realized a couple of things. One is, you don't really have control of these businesses, right? Something could happen overnight, news release, something, bad press, it could kind of change the value of the company overnight. And it's not always about the fundamentals or, there's so many factors that can go into play. And at that point, I realized, when the company is public, it was already super competitive. You're competing with guys on Wall Street with AIs and engines out there that, understand how to assess and pick stocks better than probably you can. So around that time, I came across some books by, Robert Kiyosaki. You might have heard some of their books like, Rich Dad, Poor Dad, Cash Flow Quadrant. And that's when I really learned about the idea of, building cash flow income to replace my active income. And also, how to, buy these assets that would produce, cash flow for you and leveraging debt to help you grow. So I saved a bit of money at that time and I bought some real estate, and that was in Canada, which I still own today. There was a couple, I still have a couple of rental properties and that's good. But I realized, making a few $100s, it was a bit slow for me, right? I'm impatient. I'm in my early 20s at that time. I want to accelerate. I want to make a lot of cash flow. I want to make a lot of income. So I said, okay, I learned about the real estate. So I still great. But I look at, real estate more of like maybe a 20-year investment or, kind of the investment horizon. So I know in 20 years when I'm in my 40s, it's going to be a great, source of asset that I can liquidate and, help me retire. So I thought of that time investing in an existing business. I learned about businesses and we actually built and opened a franchise gym. With the gym model, it's kind of similar to online where you have that recurring revenue. You have those 1 year, 2 year contracts. So it's pretty nice. And I do like the physical businesses. They're great, but they are super expensive. If you want to scale, right? If every time you want to build another location, you're looking at, $500,000, $1 million to, invest. So, and I also want it to be location independent. With, you have physical business, you're super dependent on where you decide to build. Just like real estate, you can't, build businesses online, live wherever, manage wherever you want to be. So with physical business, I still look at it, good investment, but I would say, like a 5 to 10 year investment horizon. And then that point, so this was when I, joined working as an engineer. I learned about online businesses where I think that's where I bought my first affiliate content site. I bought it from a marketplace called Empire Flippers. If you guys haven't heard about that, I think I was making something like $2,000 a month. And that's where I really learned about, smaller site, how about monetizing websites, playing with it, learning about SEO, how to run different conversion rate optimization tests. And that was it. I was hooked. So that's when I quit my job. Moved, I was living here in Mexico where I am now. And I joined another firm at the time, doing really what I wanted to do at the time. So I learned about this thing, buying online assets, online income, and, I wanted to share with everybody. I wanted to build a firm at the time, but I didn't know how to do it at a bigger scale. So I joined another company at the time called Wired Investors. That was back in 2016. How they were doing the same thing that I want to do, but with larger companies. They were buying $1 million plus, content sites. Then they moved into, affiliate sites, SaaS companies, productized services. So they're building their portfolio. And that's where I really learned. I got involved as the CEO of $99 Social at the time. I helped double that company, within, I think, 5 months of the acquisition, helped raise company, learned how the investments work, how to assess risk, what to look for. And that really gave me the confidence of knowing what, being involved in so many different acquisitions. I think we did about 12 in the first year, what I liked, what I didn't like, learned their playbook. And I realized the part that I really, really like was the SaaS side. That's the businesses that I was operating, working with the CEOs, helping them grow. And so over 2 years ago, that's when I kind of stepped away and I decided to found Horizon Capital. So I'm the founder of Horizon Capital. The difference, I would say, we have a slightly different approach of how we approach building a portfolio. So, typical PE firms, they're looking about, bringing, focusing for the investors, getting them returns. And yes, we do want to generate crazy returns for our investors and LPs, where we actually have an exclusive investment club. So if people want to apply, you can actually apply. But our actual core mission is actually on the entrepreneurs. That's where we focus. So I built that vision in mind at the beginning that there is another way to become an entrepreneur, rather than from starting from scratch. So that's kind of what I've done several times, is start from scratch. But the other side is, entrepreneurship through acquisition. And that's where, I got to learn how to do deals, de-risking, that kind of couple of years of 90% chance of failing. You have a company that's established, that's already found product market fit. And where we partner with these, and empower these entrepreneurs through different paths, being, CEO of an online business with our accelerated program. And that's where we do the acquisitions.
Fantastic. Cool. Thank you so much, Akeel. So started out as a petroleum engineer, now CEO of Horizon Capital. Loved as well, Kiyosaki was the guy who got you into investment. I'm sure that will resonate with a lot of people. I remember that being one of the first books I read when I was getting into business and taking, more care around my finances and looking into investment as well. So yeah, some fantastic reads there. Okay, so talk to me about Akeel then. I'm sure what a lot of our audience are going to be really interested in is what Akeel looks for, essentially. When someone's coming to him looking to raise investment or they're looking to get acquired, what is it that you're looking out for, Akeel?
So, before you kind of consider that, I want just kind of think, first thing to understand is, why do you want to raise money or why do you want to sell? Typically we see kind of the typical profile of an entrepreneur that comes to us is, they need the money. So they've shown some kind of product market fit. They've, crossed, let's say, $500,000 ARR, and now they really want to add fuel to the fire. They've done a really, really good job at building a solid product. That's typically the founder we like, but they've done a really good job in product. They've grown kind of organically, and they haven't done much marketing. And that's where we find, we come in as a growth partner. We bring in our playbook, our team that comes in and really, puts capital and then also the expertise to really accelerate growth. And the other side is if I'm looking to sell. So the type of time that, we see founders coming to us, they built this great product, 5, 6, 7 years in, and they just really hit a plateau on where they can grow the company, and they just don't want to manage it or deal with it anymore. Either they're burnt out, they want to move on to another project, they're already focusing on something else, or they just want to, it's their first time building a company and they just want to, exit and move on to another kind of business. So what we're looking for, companies over, $500,000 in ARR, sticky clients, sticking around, good product, we look at North America, Europe, doesn't matter, and just wants somebody to take care of their business, really grow it. And we actually give people the option if they want to keep roll over some of their shares and still get part of the upside as well, as we continue to grow it. So that's kind of how we work with founders.
Fantastic. Cool. So that's looking at it from your side, what you're looking for from your founders. From, I guess, this is probably more from an investor's perspective. So we've had plenty of investors on the podcast and plenty of investors listen to the podcast. So to help us, what kind of indicators do you use to evaluate, before you're going to make a big investment decision, right? So you talked about the kind of companies that you're going to get coming to you. Before you actually take that plunge and make an investment decision, what are the indicators to you that it's a good one? What green boxes are you looking to be ticked, essentially?
Yeah, no. So obviously we're focused right now as B2B SaaS companies, but if I'm looking for an acquisition, one side is super, important is overall kind of growth opportunity. What's the opportunity here? Is it a growing market, or is it dying or declining market of where you guys are positioned? Is it super competitive? Competition is fine, but are you guys kind of a leader in the place, and we can continue to grow that? And then is there quick wins where we can come in, apply our playbook? And then the other side is really about risk assessment. So one is growth. I mean, we look at that like that's kind of for us. If we can grow it and we feel there's lots of opportunity, that's for us. The market we can't control. That's just, where the market likes the business. If we like it, it's growing, that's good for us. And then the last part is we look at risk assessment. So we have 100-point checklist that we go through. And based off that, we create kind of a scorecard of, how much do we really like this business? So from 0 to 100, if it's an A+ deal, 90, 100%, we're paying obviously higher valuations for that kind of company. But the real thing is, really growth in, in your revenue. How's your growth in your users? And then we want to see sticky clients who really love the product. And then based off that, that'll really translate into your LTV or your lifetime value. You'll have lower churn. So we like churn, less than 5% a month, ideally, something like 2% a month. LTV, we like over, 1,500 or 2,000, mid-market kind of, or SMB kind of focused. Another thing we look at is the growth and the management does not depend on the owner. So we see that a lot where, the founder has that relationship with a lot of those clients and businesses and partnerships, and it's tied to that one person. And that if overnight, that founder leaves, those relationships are now in risk of losing them. And, sometimes they leave when the founder leaves as well. Another thing we look at is, let's say, does 30% of your revenue come from one client? So we've seen that before where, let's say, you're working with enterprise clients where you have one big enterprise client that's like 50% of your revenue. Now, what happens if you lose that client? Half your revenue is gone. And we've done a lot of things like that where, there's clients who represent a large sum of the revenue, but we'll usually put in some kind of clause of like an earnout to make sure that the company, continues to perform, that client sticks around for longer. And that helps us kind of de-risk the acquisition and how we value the company. But the problem becomes, and we've seen this before, where you put that earnout, that's fine. Let's say you don't pay for it. You say, okay, in 1 year, if this client sticks around, we'll pay you that value of what the company's worth, based with including that customer. But what happens is, what if you lose that customer? And that's the hard part. So if you lose 50% of your revenue, let's say, or 30% of your revenue overnight, yes, even though you didn't pay for it, now you're stuck with a company that's making 30% than what you initially thought. So rather than making, 500K in ARR, now it's making, 300 or 250 if it, dropped in half. And that puts a lot of constraint of what you're able to do with the business. You have a team that you have to manage, you have to kind of work with, and maybe you have to let go of team members. You have less money to work with, to grow, to run different experiments. So that really puts a lot of pressure on your overall investment thesis, and maybe kind of affects how you can grow moving forward.
Okay, cool. So I guess, Akeel, then the key overarching message is what you're really looking for is overall growth opportunity. Amongst other things, that's kind of at the very heart of what you're looking for and assessing, right, when someone's coming to you.
Yeah, growth opportunity, and then, what are the risks right now, and how can we de-risk this in the overall kind of, investment?
Yeah, sure. Okay, cool. So that's obviously one thing that someone coming to you is going to have to get that across, right? They're going to have to get across this growth opportunity. And I'm sure that's one of many things they get across. So what I want to dig into here, it's going to be really interesting to a lot of our listeners, is around the investment pitch, right? This famed, scary investment pitch that so many people are going to be putting together. I guess the question is, how do you get that investment pitch right?
So before we kind of get into the investment pitch, right, I want to make sure one thing clear. If you're looking to raise money, let's just, there's from that side of raising capital, make sure you're only raising what you actually need. Don't go out and say, I'll raise somewhere between 3 million and 10 million, depending on the one the market says, because, that doesn't really kind of respect, who you're looking to raise. So what I suggest is you come up with real numbers, like do some kind of assessment of what your costs will be, forecast what you'll be investing in, what is the team you actually need, how much is it actually going to cost, put real numbers in there, and then figure out what you'll actually need for the next 18 months. And then maybe, add maybe like that 10 or 20% buffer. So now you have, let's say, I need 1.5 to 2 million. Fine. That's what we're looking for. And we'll work with that. From there, the most important part, I think, is get your pitch deck right. Just like for applying for a job, right? In your world, that's your resume or your CV for investors. That's what's going to get your kind of attention. And we actually have an article on your site. If you guys want to check out how you want to structure that, you can check it out, Horizon Capital/pitch deck. But decide, why do you want to raise from VCs? There are other options out there, right? Like there's revenue-based financing. You can use debt, or you can just decide to stay bootstrap. But if you insist, like if you have a unicorn, you think you have that hockey stick growth where you can really, add fuel to the fire, and there's huge opportunity here. I'll kind of break this into 3 categories, so maybe it's relevant to different people in your audience. Okay. So first category, I would say, is like the very early stage. You just have the idea. Let's say you're working in a service business right now. I don't know, you're an accountant, you're a marketer, you're a salesperson, and you have this vision of you have this problem that needs to be solved. You're seeing it over and over again in your day-to-day, and there's a way to automate it and build a tool around it and a product that people would actually want to pay for. So at that point, what you're really selling to an investor is the story about you as the founder and the team. So those are the two things you're selling: is the founder, the team, and why they should invest in you, and why you're the right person that can tackle and actually solve that problem. Another problem that I see at this stage is, like, you need to have a technical, if you don't have technical experience, like you're not a software engineer or you're not a CTO, find a CTO that you can either hire or partner with. Don't say I'll hire a team in India to build it for me. It just doesn't work. I've seen it many, many times. Like, you get the wrong code, you get poor quality code, the wrong technology used, and that'll actually cost you more in the long run. So unless you have that CTO, don't go into SaaS. I would say at first, spend a lot of time getting the right person, then go out and sell that as a team. You're marketing, your sales, or the CEO. You have a CTO with you, and have that CTO who can manage and oversee those developers and knows what they're doing. So that's the first part, focusing on the team and you as the story of what you want to build. Second category is, I say, you've built your product. So now you've raised a little bit of money, you built your product, you go now to those initial clients that you're already working with. You've shown that there's demand and interest. And now you need to develop more features that your customer said, like, hey, like, this is what we need. And you've shown that little traction and here's proof of how we've done it. So now you're saying, okay, we've had proof, we built a product, and now we just need some money to kind of expand to help us continue to accelerate the product. So really focus on those initial customers here, what they've paid you, why they love your product, and what they're asking for, and put that in your pitch deck. So those are what you're going to be focusing on at this stage. And the last category, so you've built your product, you have strong marketing channels, your CAC, your cost per acquisition, your LTV, your lifetime value, you have the right systems to scale, you have that engine. At this point, it's really just about data. And this, I think it's similar to us. I would say when we're doing an acquisition, we look at data. And it's less about, yes, it's about the team, but I mean, that's already kind of been proven at this point. It's really about the data, looking at the analysis of how you've grown the business, looking at, churn, all those kind of cohort analysis. What's going to get the interest of the investors? And because what you're saying is, I have this engine, I've built this engine, it's doing really great. It's only firing, let's say, at half capacity. All I really need here is fuel to maybe turn on all the cylinders and add fuel to the fire of growth. So in this case, if you're creating that deck and you're in this category, just focus on the data. I just want to make one interesting note here, and it might sound a little bit maybe counterintuitive for VC specifically. The worst is actually being in between the second and third category here. So you built a product and you don't have enough traction or growth, and you wait too long to raise. And you're at this point, your chances are actually worse than someone in the first category just starting off, because showing, you have your growth isn't fast enough, isn't interesting, versus if you have nothing, which is kind of, it may sound counterintuitive.
Interesting.
So just keep that in
mind. Yeah. Okay, cool. So the message is go sooner, go harder, go sooner for it, rather than waiting out till it's almost too late, essentially, to get that back in. Okay, cool. Really interesting. I love that segmentation, Akeel, of, I guess, the three different strands or three different kind of subsections of the life cycle of a company. I think that's really interesting. Something that you said there was just around asking what you need for, and you kind of stressed the importance of that. And I was just interested to hear, how frequent is it, do you think, that people ask for actually more than they need, and how detrimental have you seen that be?
More than probably more than not. I say it's detrimental because now you have a responsibility that you have to manage, and now I think you're less, when you don't have those constraints of what you need to focus on, then you become kind of you can think about yourself too, right? When you have too much money in your bank account, you start becoming a little bit more reckless in your decisions. You start becoming less disciplined of how you decide to manage your money, unless you know exactly where it's okay, we can run these new experiments. But even then, you probably should have built that in your initial plan. And I think you just become a little bit wasteful. And I think it's a little bit lack of respect for your investors when you raise too much. And we've probably seen that countless times where people have too much money and they start just blowing it on stupid things, like fancy offices and parties and all these. So it's like, does that really drive the needle forward and give the investors returns? Probably not. So it's really up to you how you want to be seen and perceived from your investors as a founder.
Yeah, it's really interesting. I think I love the analogy of the bank account. I think we can all relate to that. If you're not disciplined, and the discipline can go with the more you have sometimes. So, okay, cool. Well, look, okay, we're talking here. Talked a lot there around the investment pitch. Those different subsections. Now let's look at, say, on the things. We've got a founder of a company, CEO, who's actually looking to sell their SaaS company. Okay, what type of valuations could someone expect? Obviously, it's going to vary massively depending. Maybe you can segment it down like you just did helpfully there of the different stages. Could you shed any light on that for our listeners?
Sure. So there's, I'll segment it too. So one is you're trying to raise money from a VC for growth. Mm-hmm. And that's what we typically see in the news, right? You see this on TechCrunch, you see this on all these, news articles of, hey, they just raised $100 million on $3 billion valuation. And the problem is we get those conversations with us for people who want to sell their company. If you're looking to sell your company, it's a totally different story. But I would say like the number one metric that matters is going to be your growth rate. So are you growing 10% year over year, 30% year over year, or 300% year over year? And that's going to be two different things. What we look at typically is, we're not competing with VCs. If you're doing 100%, 200% year over year growth, go raise funds. That's probably the better way through the VC route. We're looking at 20%, 30%, maximum 50% year over year growth. That's what we like. When you're selling your company, the value of the company of what you're selling now is actually based on the present value of its kind of future cash flow. So if we're looking at ARR, what's your ARR right now? And then we're looking at your EBITDA or your seller discretionary earnings. We don't look at companies that are burning capital. You're burning 10, 20, 30K a month. That's not interesting to us. VCs will probably be more interested there. In terms of valuation, also I'll break that down into two types of buyers as well. There's financial buyers, which is like somebody like us, and then you have strategic buyers. So somebody like us who's going to look at a SaaS company in this range, let's say at this growth rate, which I talked about, we're typically paying somewhere between 2 to 3x ARR. So that's what you can kind of expect. Maybe even 3.5, maybe 4, depending on your growth. If you go to a strategic buyer, so these are your Googles, your Facebook, your Amazon, or even your competition, maybe there's a leader in the place who might be interested. And we actually do M&A for some companies, SaaS companies who want to buy, be acquired by strategics. At this point, you can get generally a lot higher valuation. It could be anywhere between, we've seen 5x up to maybe 8 or 9x ARR. So obviously you'll expect a little bit more, but there's a lot more integration. That they're buying your customers. Maybe your product is, they can see a lot more quick wins just by integrating you or the team or your product a lot quicker. And then on the VC side, the assumption here, the reason why you can ask for more money is like, let's say company needs $3 million to accelerate growth. Then in 1 year, that cash flow will be a lot higher than if the company didn't raise funds, right? So you have to look at it like that. It's like, if I don't raise this 3 million, my company just won't be, it's just going to be worth more because I have all this money to invest and grow it. And that's why it's based on future, with that money invested. So it's a little bit tricky on how to think about it, but don't think of the same thing of raising funds with selling your company when looking at valuations. When it comes to valuations on the VC side, we're seeing anywhere between, I would say, like 8 to 12x ARR is not kind of not untypical for how you structure your round.
Interesting. Cool. Well, we're coming towards the end of our time, Akeel, today. I think a good question to perhaps leave this on and for you to maybe share something on would be for all those young entrepreneurs out there who perhaps have started up a business at the very early stage and they're just about to think about going out there and getting some kind of capital behind them, right? They're going to take their business to the next level. What would be your biggest piece of advice to them?
Okay, so if you're bootstrapping, use your customers as your capital. I mean, take customers as your way of growing. I mean, I typically love that. I mean, I'm more of a fan of the bootstrap approach versus the VC approach. So you can go out and raise it if you think you have a massive market opportunity and you need the money to kind of get out there, and everybody needs to know about it. And you want to be that person who's managing, to a unicorn, being a CEO of a 100+ company very, very quickly. move that route. There's nothing wrong with being bootstrap. I love it. Use your customers as your source of capital.
I love that. I had a guest on the other week, and we were talking about that exact model actually. Rather than sometimes, I think, as you said, there is a path and a route for the VCs, but I think sometimes young entrepreneurs can think that somehow is the mark of success, is to go out there and get the funding. Whereas actually, what you're saying there is there's plenty of other ways in which to raise capital, which are equally as valuable and perhaps less costly as well in the run.
Exactly.
So fantastic, cool. Well, Akeel, look, thank you so much for your time today. Really appreciate everything you've shared with us. Good luck with all you're doing over at Horizon Capital, and thank you for sharing.
No, thank you for having me on, Connor. Much appreciated.
Cheers, Akeel.
Cheers.